India's fund management industry has been built on the shoulder of stalwarts and experts who swear by the virtues of investing in a systematic manner, in a disciplined manner for the long term without trying to indulge in any kind of market timing. My dear friends, isn't it funny that for an industry that indulges in such strong virtue signaling against the idea of market timing, the single largest scheme on offer for investors to invest in is a product in which the primary mandate of the fund manager is to do nothing but market timing. My dear friends, those of you who have followed me on my channel would of course know that I for one have no such qualms with the idea of market timing, provided of course that the pursuit of market timing is driven not by some kind of a sixth sense or hunch or gut, but based on a rigorous analytically driven approach. And that's because I truly believe that right through the history of equity markets is the uncanny ability of legendary investors to be able to get in and out of equity markets at the right time is what has separated the men from the boys. And that's why I want to use this opportunity to share with you a unique investment strategy to time your investments in equity markets such that you can capture the upside of equity markets during times when market conditions are favorable, and yet at the same time, even if you encounter a large market correction during the course of your investment horizon, you are able to exit your investments with returns that are at least comparable, if not higher than that of bank fixed deposits. Hello everyone. Welcome to the part 3 of this series where we are exploring techniques through which we can invest for a financial goal that is due in, let's say, 4 to 5 years from now, such that we can end up with at least low double-digit returns, 11 to 12% per annum at the end of a 5-year SIP, irrespective of how market conditions turn out to be during the course of the SIP. In part 1 of this series, we discussed some of the fatal flaws of a conventional SIP-based investment approach, which can have grave implications, especially if the purpose of your SIP is to save up for a financial goal that is due in, let's say, 4 to 5 years from now. We saw in part 1 of this series that historically, the outcome of a 5-year SIP almost entirely depends on how market conditions turn out to be during the course of your SIP. If market conditions turn out to be favorable, if markets are witness to very strong rallies during the course of your SIP, then you can end up with returns as spectacular as 45% per annum. However, if you're unlucky and if you encounter a large market correction during the course of your SIP, especially if this market correction comes closer towards the end of your SIP, then you can end up with returns as bad as negative 5.82% per annum. And that would almost certainly mean that you will fall short of the amount that you are targeting to save up by the end of your SIP. In effect, you will fail to achieve the financial goal for which you were investing. But is there a solution to this problem? Is there a way to invest for a financial goal in such a way that we can end up with at least a low double-digit return, 11 to 12% per annum at the end of a 5-year SIP, irrespective of how market conditions turn out to be during the course of that 5-year SIP? We tried to explore a solution to this very problem in part 2 of this series. If you have not seen part 2 of this series, I strongly encourage you to go and have a look at that video. I've left a link of that video in the description of this particular video. In part 2 of this series, we discussed a very unique investment strategy through which we can introduce an element of timing our SIP investments based on the prevailing PE ratio, price to earnings ratio of the Nifty. Now, to quickly recap this strategy, this is what we discussed in part 2 of this series. So first, we discussed this chart. This red line represents how the Nifty's PE ratio has moved over the last 25 years. This chart also shows us that the long-term average of the Nifty's PE ratio over the last 25 years has been about 20. And the Nifty is deemed to be overvalued whenever the Nifty's prevailing PE ratio goes significantly above its long-term average of 20. In fact, the Nifty is considered to be dangerously overvalued whenever the Nifty's prevailing PE ratio goes to these super high levels of 27, 28. Because historically, these are the points when the Nifty has historically witnessed some of its largest corrections. To understand this better, we need to look at this chart in conjunction with the chart of the Nifty itself. So the blue line that you see on the screen right now represents the Nifty itself, shows us how the Nifty has moved over the last 25 years. And when you look at these two charts together, you can very clearly see that historically, whenever the Nifty's P ratio has gone above 28, the Nifty has witnessed very, very large corrections. So for example, the first time the Nifty's P ratio went above 28 was in February of 2000, and that was followed by a 51% correction in the Nifty. The second time the Nifty's P ratio went above 28 was in January of 2008, which was followed by a 60% correction in the Nifty. The third time the Nifty's P ratio went above 28 was just before the COVID pandemic, and yet again we got a fairly large 38% correction in the Nifty. Now, based on this understanding of the Nifty's P ratio, I had proposed a common sense investment strategy. So this is what I had proposed. What I had proposed is that on the first trading day of every month, on the day when you do your SIP investment, you should rebalance your entire investment portfolio between Nifty and a liquid fund based on the prevailing P ratio of the Nifty. In more specific term, what I had basically proposed is that on the first trading day of every month, you should check what is the prevailing P ratio of the Nifty. In any given month, if the P ratio of the Nifty happens to be above 28, that means the Nifty is very, very overvalued, then for that particular month, you should move your entire investment portfolio out of Nifty and you should move it to a liquid fund. 100% of your portfolio you should move to a liquid fund. In any given month, on the first trading day, if the Nifty's prevailing P ratio happens to be between 23 and 28, then you should move 25% of your portfolio to Nifty and the remaining 75% to a liquid fund. If the prevailing P ratio on the first trading day of any given month happens to be between 18 and 23, then you should have 50% of your portfolio in Nifty and the remaining 50% in a liquid fund for that month. If prevailing PE is between 15 and 18, then 75% of the portfolio should be in Nifty, the remaining 25% should be in a liquid fund, and in any given month, if the prevailing PE ratio happens to be below 15, less than 15, that means the Nifty is very, very undervalued, then for that particular month, you should move your entire portfolio to Nifty. Once again, to summarize, I had proposed that you should rebalance your portfolio on the first trading day based on the prevailing P ratio of the Nifty. And how long you should be doing this rebalancing exercise for? I propose that you should do this rebalancing on the first trading day for 5 years, for 60 months. And when you do this rebalancing exercise based on this strategy for 60 months, historically, the outcome of the strategy has been very, very impressive. So this has been the historical performance of a conventional 5-year SIP in the Nifty. We saw this chart a little while back. The best case return of a conventional 5-year SIP in the Nifty so far has been about 45% per annum, and the worst case return of a conventional 5-year SIP in the Nifty so far has been negative 5.82% per annum. Now let's see what has been the historical performance of the new P-based strategy that we just discussed. This has been the historical performance of a 5-year SIP had you done monthly rebalancing for 5 years based on the prevailing P ratio of the Nifty, basically the new strategy that we just discussed. The best case outcome of a P-based 5-year SIP in the Nifty so far has been 39.26% per annum. In case of a conventional 5-year SIP, it was 45% per annum. That has come down by about 6 percentage points in case of a 5-year P-based SIP. But look at the worst case outcome. Historically, the worst case return of a P-based 5-year SIP in the Nifty so far has been positive 5.4% per annum. In case of a conventional 5-year SIP, it was negative 5.82% per annum. That has improved by more than 11 percentage points to positive 5.4% per annum in case of a P-based 5-year SIP in the Nifty. So effectively, with this new P-based strategy, you would have ended up with as high as 39% per annum return had the Nifty delivered very good returns during the course of your 5-year SIP. But even if the Nifty would not have delivered good returns during the course of your 5-year SIP, you could have still ended up with returns of positive 5.4% per annum. Positive 5.4% per annum, by the way, is almost what a bank fixed deposit would have yielded you. Now, many of you have commented that this strategy that I presented in part 2 of this series is something which is infeasible, something which cannot be implemented in a real world because this involves rebalancing the portfolio every single month. And when you rebalance the investment portfolio every month, that is likely to lead to a lot of capital gains. In fact, when you rebalance your portfolio every month, most of the gains are likely to be short-term gains. And as we know, in this year's budget, taxation on short-term gains has been increased even further. My dear friends, this is a very, very legitimate concern. But at this stage, I humbly request all of you to have some patience. Taxation is something that I will address towards the end of this series. In fact, believe me, I'm going to give you a very unique solution towards the end of this series through which you can potentially make all the gains that are likely to accrue to you from a strategy like this completely tax-free. But for now, let's get back to understanding the logic behind the investment strategy that we are discussing. So this is what you get when you introduce an element of market timing based on just one market timing parameter, which is P ratio of the Nifty. Can we do better than this? Especially, can we push up the worst case outcome even further? Of course we can. And the way to do that would be to make our market timing logic even more sophisticated by adding additional market timing parameters to our market timing logic. And this brings us to the second and probably the most important market timing parameter of our market timing logic, which is liquidity. It's important to understand the impact of liquidity on equity markets more so because it can also help explain one anomaly in the historical relationship between the Nifty's P ratio and the Nifty itself. What exactly is this anomaly that we are talking about? Well, we just saw that historically, whenever the Nifty's P ratio has gone above 28, every single time we have witnessed very, very large corrections in the Nifty. But we saw one notable exception to this rule in the aftermath of the COVID pandemic. The Nifty's P ratio went above 28 only for the third time in its history before the COVID pandemic, and predictably, this was followed by a 38% correction in the Nifty. But after this correction had played out and the Nifty had bottomed, the Nifty started to rebound very, very strongly. And as the Nifty started to rebound very, very strongly, the Nifty's P ratio also started to rebound very, very strongly. But this time round, the Nifty's P ratio did not stop at 28. In fact, this time round, the Nifty's P ratio did not even stop at 30. It did not stop at 35. It did not even stop at 40. This time round, the Nifty's P ratio went all the way up to 42. Which has so far been the highest level to which the Nifty's P ratio has ever gone to. And what is even more surprising is that despite the Nifty's P ratio going all the way up to 42, this time round, we did not see any significant correction in the Nifty. So why did we get what looks like a breakdown in this long-standing rule of Nifty witnessing a large correction whenever the Nifty's P ratio goes above 28 in the aftermath of the COVID pandemic? Well, for that, we need to understand the second market timing parameter of our market timing logic, which is liquidity. But what exactly is liquidity? Well, liquidity represents the amount of money that is coming into equity markets. And what is the source of liquidity? Well, there are multiple sources of liquidity, but the most important source of liquidity is the amount of new money created by central banks. Well, what are central banks? Well, every country has a central bank. In case of India, the Reserve Bank of India, the RBI serves as our central bank. In case of the US, the Federal Reserve, or the Fed in short, serves as their central bank. And the primary function of the central bank of any country is to decide the amount of new money that must be created, that must be printed into existence and released for circulation in the economy. And when central banks print new money and release this new money for circulation in the economy, liquidity conditions tend to improve. And when it comes to new money printing by central banks, it is the money creation, money printing undertaken by the US central bank, the Federal Reserve, which has the most profound impact on liquidity conditions, not just in the US, but pretty much around the world, including here in India. Why is it that? That's because the US central bank, the Federal Reserve, prints into existence the US dollar. US dollar, as many of you might know, is arguably the most important currency in the world. And when Fed prints new dollars into existence, some of these new dollars are brought from the US to emerging markets like India by what are called FIIs, foreign institutional investors. And as a result, whenever you have money printing happening in the US, that results in liquidity conditions improving not just in the US, but liquidity conditions improving in emerging markets like India as well. Let's try to understand this through some charts. The chart that you see on your screen right now represents what is called the Fed's balance sheet size. Now, this is a chart that I have used in many of my previous videos. But you have not seen this chart previously. I know this sounds like a lot of technical mumbo jumbo. But don't worry, I'm going to break it up for you in very, very simple language. In layman terms, what this chart basically represents is the amount of new US dollars that the Fed has printed into existence over the last 15 years. Whenever the red line goes up, that basically represents that the Fed has printed that much amount of new US dollars into existence. This chart also shows us that there have been two distinct occasions when the red line has gone up at a very, very fast pace. The first time this happened was from late 2008 onwards, and the second time this happened was after the onset of the COVID pandemic. On both these occasions, we can see that the red line went up at a very, very fast pace. This basically means that during these two instances, the Fed printed US dollars at a very, very aggressive pace. The process through which the Fed prints new US dollars into existence at a very rapid pace is also referred to as quantitative easing, QE. But why did the Fed have to conduct QE from late 2008 onwards and once again in 2020? Well, the Fed had to print a lot of money and conduct QE in 2008 because the US economy witnessed one of the worst recessions in its history in 2008. And in response to that, the Fed conducted QE and printed a lot of money in order to provide liquidity support both to the US economy as well as US financial markets. The same thing happened in 2020. In the aftermath of the COVID pandemic, the US economy slipped into a recession once again. And in response to that, the Fed conducted QE once again in order to provide liquidity support both to the US economy as well as to the US financial system. How much amount of new US dollars were printed into existence as part of these two instances of QE? Well, in the QE, in the aftermath of the 2008 recession, the amount of money that was printed was about $3.5 trillion. How did we get this $3.5 trillion? Well, at the start of the QE, the Fed's balance sheet size was about $1 trillion. By the time the Fed was done with this round of QE, the Fed balance sheet size had gone up to about $4.5 trillion. So basically, balance sheet size going up from 1 trillion to 4.5 trillion. This basically means that during this time, the Fed printed 4.5 minus 1, $3.5 trillion. How much money was printed in the aftermath of the COVID pandemic? Well, this time round, Fed printed money at a even larger scale. This time round, the Fed balance sheet size went up from about $4 trillion to almost $9 trillion. So basically 9 minus 4, almost $5 trillion worth of new US dollars were printed into existence. And what is the impact of all this money printing on equity markets? Well, money printing always turns out to be a very, very positive factor for equity markets. To understand this better, I have overlaid the chart of the Nifty onto this chart. The blue line that you see here represents how the Nifty has moved over the last 15 years. And as you can see, whenever the Fed has conducted quantitative easing, QE, that is, whenever this red line has gone up at a very fast pace, that has helped improve liquidity conditions. And as a result, the Nifty has also rallied very, very strongly on both the occasions when the Fed has conducted QE. In fact, the scale of the QE conducted by the Fed in the aftermath of the COVID pandemic was so large that the resulting liquidity support received by equity markets around the world, including Nifty here in India, was simply unprecedented. So unprecedented that the Nifty continued to rally right through 2021 despite the Nifty's PE ratio going to an all-time high of 42. Now this has important lessons for us as investors. So far we have discussed two market timing parameters as part of our market timing logic. The first is the P ratio of the Nifty. Second is the amount of money printed by the Federal Reserve. The P ratio of the Nifty represents the valuation of equity markets, and the amount of money printed by the Federal Reserve represents liquidity conditions. Now, back in 2021, we were getting very conflicting signals from these two market timing parameters. In terms of the P ratio of the Nifty, markets were clearly very overvalued back in 2021. The P ratio of the Nifty hit an all-time high of 42 in March of 2021. And the implications of P going to an all-time high of 42 was that market should have ideally corrected back then. However, we never saw any significant pullback in 2021. In fact, markets continued to rally very strongly right through 2021 despite the P ratio of the Nifty hitting an all-time high of 42. And this happened because of the strong liquidity support received by equity markets around the world, including the Nifty here in India. What does this mean? This means that liquidity is a far more powerful factor in determining the future direction of the Nifty compared to any other factor, including valuations. When equity markets are receiving liquidity support from the Federal Reserve because of money printing at a very aggressive pace, valuations do not matter. During such time, P ratio of the Nifty can be 42, P ratio of the Nifty can be 142. Markets will not correct. But that is not to say that valuations and P ratio of the Nifty do not matter anymore. Valuations will always matter. But valuations will have bearing on the future direction of the Nifty only when the Fed is not intervening in the markets to provide liquidity support to equity markets. Now, based on this, we have to make certain changes to our monthly rebalancing logic. So far, we were looking at the prevailing P ratio of the Nifty on the first trading day of every month to decide the asset allocation of our portfolio for that particular month. Now what we need to do is, instead of looking at the P ratio of the Nifty first, we need to first look at whether the Fed is printing money at a very fast pace or not. And if the Fed is printing money at a very fast pace, then for that particular month, nothing else matters. We can straight away go to 100% equity in our SIP portfolio. But how can you conclude if the Fed is printing money at a very fast pace as of a given month or not? Well, for that, you need to look at the shape of this red line. If this red line has gone up at a very fast pace over the last 1 year, then that effectively means that Fed is continuing to print money at a very fast pace. And if that is indeed the case, then for that month, nothing else matters. You should simply go to 100% equity in your SIP portfolio. So this is what I'm proposing that you should do every month. On the first trading day of every month, you should first look at what is the current level of the red line. Then you should go back 1 year and try to find out what was the level of the red line 1 year back. That will help you calculate by how much this red line has gone up or gone down by over the last 1 year. If you find that this red line has gone up by 25% or more than 25% over the last 1 year, then that, according to me, is a sufficient condition to conclude that the Fed is continuing to print money at a very fast pace. And if that is the case, then for that particular month, you need not look at anything else. You can simply go to 100% equity in your investment portfolio for that month. But if you find out that over the last 1 year, the red line has gone up, but by less than 25%, or if the red line has not gone up at all, or still worse, if the red line has in fact gone down over the last 1 year, then that effectively means that the Fed is not intervening to provide liquidity support to markets as of that month. And in that case, for that month, you can decide the asset allocation of your portfolio based on the prevailing P ratio of the Nifty. We discussed this PE based rule earlier in this video. What is the outcome of a 5-year SIP when you introduce an element of timing your SIP investments based on two market timing variables? First, the P ratio of the Nifty, and second, the rate of change of the Fed's balance sheet size. So this is the historical performance of a 5-year SIP if you introduce an element of market timing based on one parameter, P ratio of the Nifty. We saw this chart a little while back in this video. And this is the historical performance of a 5-year SIP if you introduce an element of market timing based on two parameters, prevailing P ratio of the Nifty and rate of change of the Fed's balance sheet size. The best case outcome continues to remain the same, 39.26% per annum. But the worst case outcome improves by one more percentage point. It goes up from 5.4% per annum to 6.37% per annum. Even the median case outcome improves from 12.38% per annum to 16.06% per annum. That's an improvement of more than 3.5 percentage points. By the way, what exactly is meant by median case return and how does median case return differ from average case return? Let's quickly understand that as well. What we have here is a list of 223 months, and against each of these 223 months, we have the return of a 5-year SIP starting that month. If you pick up these 223 return figures and you list them down one below another, you will get a list of 223 return figures. Then what you got to do is to arrange these 223 return figures in ascending order. After arranging these return figures in ascending order, you need to pick up the return which figures exactly in the middle of this list, in the midway point of this list. If you have 223 data points, the return figure which figures at rank number 112. 112 is the exact midway point of a data set which has 223 data points. So the return figure which figures at rank number 112 is the median of this data set. And the return figure which figures at rank number 112 happens to be 16.06. That's how you get the median case return to be 16.06% per annum. But how does median differ from average? Well, if you have to find out the average of this data set, then what you need to do is add up all these return figures and then divide it by 223. That's how you get the average of this data set. The average case return of this 5-year SIP in the Nifty based on the two variable logic happens to be 18.3% per annum. The median is 16.06% per annum. The average case return is 18.3% per annum. But why is it better to look at the median case return compared to instead of the average case return? Well, if you're trying to look for the midway point between best case and worst case, then statistically it's better to look at median return instead of average, because average tends to get swayed if you have one best case outcome which is very, very high, or if you have one worst case outcome which is very, very bad. Average will get swayed because of that. But median doesn't get impacted if you have a couple of outlier cases on the best case side, or if you have a couple of outlier cases on the worst case side. Then median doesn't get impacted by that, but average does. And that's why statistically, if you're trying to look for the midway point between best case and worst case, it's better to look at median rather than average. And this is not even the most important improvement in outcome that accrues to you when you incorporate market timing based on these two market timing variables, P ratio of the Nifty and rate of change of Fed's balance sheet size. What else improves when you incorporate market timing based on these two variables? In part 1 of this series, we had seen that in case of a conventional 5-year SIP in the Nifty, a SIP in which you're not trying to do any market timing. In case of a conventional 5-year SIP in the Nifty, the historical probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP in the Nifty, historically so far, has been 53%. How did we get this 53%? This chart that you see on your screen right now depicts the historical performance of a 5-year SIP in the Nifty. We had seen this chart in part 1 of this series. From this chart, we can see that since the turn of the century, since January 2001, So far, 223 months have already passed by. And had you started a 5-year SIP in the Nifty in any of these 223 months, then the return that you would have got at the end of each of these 5-year SIPs is something that I have tried to tabulate in this chart. And if you want to find out the historical probability of getting a return of 12% per annum or more at the end of a 5-year SIP in the Nifty, then what you need to find out is, out of these 223 months, in case of how many months did a SIP in the Nifty over the next 5 years produce a return of 12% per annum or more. And when you do that exercise, you'll find out that only in case of 119 months, 119 out of 223 months, a SIP in the Nifty over the next 5 years produced a return of 12% per annum or more. 119 out of 223, that effectively translates to a probability of only 53%. Why do I say only 53%? That's because when you flip a coin and you try to guess whether you're going to get heads or tail, the probability that your guess is going to be right is 50%. So effectively what that means is that when you do a 5-year SIP in the Nifty, the probability that you're going to end up with a return of 12% per annum or more at the end of that 5-year SIP is almost the same as getting a flip of a coin right. Just imagine. Well, this is what you get in case of a conventional 5-year SIP. In case of a conventional 5-year SIP, the historical probability of getting a return of 12% per annum or more at the end of a 5-year SIP in the Nifty has been only 53%, 119 out of 223. Now just take a guess by how much this probability can potentially improve when you introduce market timing in your SIP based on the two market timing variables that we just discussed, P ratio of the Nifty and rate of change of Fed's balance sheet size. Well, this is what you get when you introduce market timing based on the two market timing variables that we just discussed. The historical probability of ending up with a return of 12% per annum or more at the end of a 5-year SIP goes up to as high as 83% when you introduce market timing based on P ratio of the Nifty and rate of change of the Fed's balance sheet size. Probability goes up from 53% to 83%. That's an improvement of 30 percentage points. Now, can we do still better? Of course we can. So far we have been applying our two variable market timing logic to the Nifty. When you apply our two variable market timing logic to the Nifty, historically the best case outcome has been 39.26% per annum, the worst case outcome has been 6.37% per annum, and the median case outcome has been 16.06% per annum. Now let's try to apply our two variable market timing logic. Instead of the Nifty, let's apply this logic to an actively managed large cap fund. And the fund that I have selected for the sake of illustration is HDFC Top 100 Fund. Now, I'm not trying to endorse this fund. I'm not trying to recommend this fund. The only reason I have selected this fund for the sake of illustration is that I was looking for a large cap fund for the sake of this illustration, because so that the fund has, in terms of its composition, is somewhat similar to the Nifty. Nifty, by the way, is also a large cap index. The second reason I selected this fund for the sake of illustration is that I was looking for a fund which has publicly available NAV data going all the way back to January 2001. So this fund met that criteria as well. So now let's go back and check what would have been the historical outcome of a 5-year SIP with our two variable market timing logic when you applied that logic to this particular fund. So this would have been the historical outcome of a 5-year SIP if you would have applied our two variable market timing logic to the HDFC Top 100 fund. The best case outcome would have been as high as 57.84% per annum. The worst case outcome also would have gone up to almost 7%. In case of Nifty with our two variable market timing logic, the worst case was 6.37% per annum. That improves further to positive 6.9% per annum when you apply the logic to HDFC Top 100 fund. Look at the median case. Median case goes up to 18.63% per annum. In case of Nifty with our two variable market timing logic, it was 16.06% per annum. That improves by more than 2.5 percentage points to 18.63% per annum when you apply the same logic to HDFC Top 100 fund. How about the probability of ending up with a return of 12% per annum or more? Well, that probability also goes up to 89%. In this case, out of 223 months, in as many as 199 months, the outcome of a SIP over the next 5 years would have been 12% per annum or more than that. So this is what you get when you apply market timing using two market timing variables, P ratio of the Nifty and rate of change of Fed's balance sheet size. In case of our paying clients, we use a comprehensive market timing logic consisting of more than 15 market timing variables covering both domestic as well as global macro parameters. Internally, we refer to this comprehensive market timing logic as the AlphaSIP strategy. Some of the key global macro parameters which are part of our comprehensive macro timing logic, the AlphaSIP strategy, is something that I had discussed in this earlier video of mine which I had published on 6th of April 2024. In this video, I had discussed global macro parameters such as the yield curve, the reverse repo facility, and the Fed funds rate. These three are some of the most important market timing parameters which are part of our comprehensive market timing logic. And when you apply our comprehensive market timing logic consisting of more than 15 market timing variables to a top rated large cap fund such as the HDFC Top 100 fund, this is the kind of outcome that you get in terms of historical performance of a 5-year SIP. Best case return of 56.5% per annum. Most importantly, look at the worst case. The worst case return also so far has been as high as 13.5% per annum. Median case return 24.3% per annum. Now I have to reiterate this with every grain of my existence that all of this is merely historical performance of these strategies and they must be treated as such. Even by a stretch, these numbers should not be considered as even an indication, much less an assurance that these kind of returns can be achieved in future as well. And I'm not saying this just for the sake of giving a bland disclaimer. I really mean it. In this video itself, I explained how all the way since the inception of the Nifty till 2020, the Nifty 50's P ratio never went above 30. But that was still the onset of the COVID pandemic. Just see how dramatically that changed in the aftermath of the COVID pandemic. In the aftermath of the COVID pandemic, the P ratio of the Nifty not just crossed 30, it went all the way up to 42. What does that tell us? It tells us that just because equity markets have behaved in a certain way in the past is no guarantee that they will continue to behave in the same way going forward as well. And this is something that we have to keep in mind at all times. Now coming to a few of the operational challenges that you're likely to face while implementing this strategy. And this could sound a bit of anticlimax, but it's going to be very, very infeasible to implement this strategy using vast majority of mutual funds available in our country. And that is because of two reasons. First reason is exit load. In case of vast majority of equity mutual funds in our country, there's a 1% exit load that mutual fund companies charge in case of switch outs and redemptions within the first 1 year of investment. Now, the strategy that we discussed involves rebalancing the investment portfolio between an equity fund and a liquid fund every month on the first trading day for a period of 5 years. Now, if you are going to rebalance your portfolio between an equity fund and a debt fund every single month, based on the proprietary logic that we discussed in this particular video, then every month you will end up incurring this 1% exit load. And that will eat away a very large part of the gains that are generated for you by this strategy. And this is the first reason why it's going to be very, very difficult to implement this strategy using mutual funds. The second operational challenge that you are likely to face while implementing this strategy is with respect to taxation. I have already alluded to this issue earlier in this video, but to elaborate a little more, when you do rebalancing of the portfolio as per this logic every month, you are going to end up generating a lot of capital gains. In fact, when you do monthly rebalancing, most of these gains are likely to be short-term gains. As we know, in this year's budget, the finance minister has increased the taxation on both short-term gains as well as long-term gains. In fact, the taxation on short-term gains has been increased very, very substantially. So what is going to be the quantum of taxation applicable? Well, gains from equity funds, if the gains are short term, will be taxed at the rate of 20% of the gains. Gains from debt funds will be taxed as per your slab. Now, if you are a salaried individual who is already in 30% slab, then all gains from debt funds will be taxed at 30%. So equity gets taxed at 20%, debt, let's say, gets taxed at 30%, the average comes to 25%. The actual weighted average tax rate is likely to be less than 25% because most of the gains will come from equity funds. Almost 70-75% of the gains are going to come from equity funds. So the weighted average tax rate is likely to be closer to the tax rate applicable for equity funds. So the weighted average tax rate is likely to be somewhere around 22 to 23%. But my dear friends, don't worry. As I've already mentioned earlier in this video, I'm going to give you a very, very elegant solution that is going to address both these two problems, exit load as well as taxation. In the next part of this series, which is going to be the concluding part of this series, I'm going to give you a very unique solution through which you can potentially make all the gains that you will be able to generate from this strategy completely tax-free. My dear friends, I am now drawing towards the end of this video. My primary purpose behind doing this video and this series was to share hard data with my audience to counter the dominant narrative that retail investors cannot and should not time their investments. I find this narrative to be very, very problematic, even hypocritical. Because more often than not, this narrative originates from the so-called experts sitting in the various fund houses of this country. Why do I say that I find this narrative to be hypocritical? My dear friends, do you know what is the name of the single largest mutual fund scheme in this country? Not the largest debt fund, not the largest equity fund, not the largest fund in any specific category, the single largest mutual fund scheme across all categories. The name of that fund is HDFC Balance Advantage Fund. As of August 2024, this single scheme has assets under management worth more than 94,000 crores. Now, what is the category of this particular fund? Well, the category of this fund is there in the name of this fund itself, Balance Advantage. Balance Advantage is the category of this fund. What is the Balance Advantage category about? Well, in the Balance Advantage category, the fund manager has the discretion to go down on equity exposure of the fund all the way down to 0% during times of financial market downturns. And the fund manager has also the discretion to go up to as high as 80 to 100% equity exposure during times of strong bull runs. Well, if this is not trying to time the markets, what else is? My dear friends, isn't it funny that for an industry which indulges in such strong virtue signaling against the idea of trying to time the markets, the single largest offering for retail investors to invest in, a sort of a flagship offering of sorts, is a product in which the primary mandate of the fund manager is to do nothing but time the markets? And I'm not even trying to single out HDFC AMC here. So you have almost every fund house offering a Balance Advantage fund in which they are trying to actively time the market. How many fund houses have you come across which have taken a principled stance that timing the market is not possible and hence they are not going to offer a Balance Advantage fund? I don't know of anyone. And that's why I find that it's very, very hypocritical for these fund houses and their fund managers to suggest that investors cannot and should not try to time the markets when they are trying to do that day in, day out. The reason I believe most of these fund managers advise everybody else not to try to time the markets is because they themselves do not do a very good job of timing the markets. What do I mean by that? Well, this has been the historical performance of the AlphaSIP strategy. I showed you this chart a little while earlier in this video. Forget about the historical performance of the AlphaSIP strategy, which involves 15 timing variables. This is the historical performance of a market timing logic involving just two variables, P ratio of the Nifty and the Fed's balance sheet size. I can assure you there is not a single Balance Advantage fund in this country which can match the performance of even this two variable logic. Worst case return of 6.37% per annum and median case return of 16.06% per annum over a 5-year investment horizon. I don't think there is a single Balance Advantage fund in this country which can match the performance of even this two variable logic. My dear friends, I'll try to do a separate dedicated video comparing the performance of various leading Balance Advantage funds with the historical performance of the market timing logic that I have discussed in this particular video. Otherwise, this video will become very, very long. Anyways, my primary intent here is not really to pick on the performance of balance advantage funds. My primary intent here is to address those who dismiss the idea of market timing and present hard data to them to explain what kind of tangible outcome can be realized by incorporating an element of market timing in your personal investments, and how that outcome can be quantifiably superior to the outcome of conventional SIP-based investments. I hope this video can serve as fodder for thought for all such people. This brings me to the end of this video. I really hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you very much.